Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. I've been helping clients save millions of pounds over the last 18 years in their inheritance tax planning. So today's video is around what are the interactions with HMRC during the setup and running of trusts. So welcome back, and today's video is around what are HMRC's interactions during the setup and running of trusts. So these days nearly all trusts have to be registered with HMRC, and the interactions with HMRC depend upon the type of trust. Now, estate planning trusts usually only hold an initial £10 note, so this is lifetime trusts as opposed to people other lawyers who set up will trusts. So our trusts, we put the £10 in, we register the trusts. Now, since the assets in these trusts go into these trusts after death, there is no need to do a tax return every 10 years after the registration, because there is nothing in the trust other than the £10, right? However, after death, then that's a different matter. So when the assets go into trust on the death, those assets are registered with HMRC at the time. So if the assets remain in the trust and they're not taken out, they are liable potentially for a 6%, that's the current rate, periodic charge at the 10-year anniversary of the date the assets are passed into the trust. Okay? Now, the 6% charge is only applied if the value of the trust exceeds 325,000 in most cases on the 10th anniversary. And as I say, it's a 6% charge. Now, sometimes where we set up a number of different trusts during lifetime on different days, the trust will have different allowances. So effectively, if the value of the trust exceeds 325,000 at the 10-year anniversary of the assets going in, there would be some 6% tax charge to pay. At least that's the current rate. Now, if the trust holds any assets which produce an income or records a capital gain of any description, that income or capital gain has to be registered with the HMRC in the year that arises. So if you've got a discretionary trust and you own a bank account in there, and you've got some property in there which has got income coming in, or you've got shares which are producing dividends, those incomes and capital gains have to be registered every year. But in most cases, and certainly when we set them up, people end up holding offshore bonds within the trust, and that doesn't allow anything. So the offshore bond is effectively a closed box where the growth takes place inside the bond with no leakage and therefore nothing to declare until the 10-year anniversary. So because all capital gains, all income take place inside, there is no return effectively required. Okay, so with HMRC, yeah, there's some setup in the first place and the registration, and then it depends upon the trust itself and whether there are assets in the trust and whether those assets are producing income or capital gains. And if so, those income and capital gains have to be registered on an annual basis. But if not, the trust is just holding a £10 note which doesn't grow, or effectively it's holding an offshore bond which the assets grow inside, there is no need to do everything until the 10-year anniversary. So that's how it works. We help our clients do their trust returns anyway under our tax accountancy company, and therefore our clients are fine in terms of sorting these things out on an ongoing basis. Okay, if you enjoyed that video, just give us a quick thumbs up and a like. Thanks for listening, and goodbye for now. Bye.